the audience is banned from any material that bears the name or symbol of a competing university. We kindly ask that the audience exit the room immediately following the question and answer period. Competitors, you may begin when you are ready.
Good afternoon, Mr. Wall and Mr. Wilson, and thank you so much for joining us today. My name is Leah, and these are my colleagues Jen and Evan, and we are here today from King, Patterson, and Matheson to discuss with you the tax implications with regards to the acquisition of DRB, as well as some secondary concerns that you asked us to address. So I'd like to start off our presentation by going over a quick agenda of what we will be discussing today. I'll be going into an analysis of your current situation, as well as identifying the primary and secondary issues that we'll be discussing. Next, Evan will be going over our alternatives and providing you with our recommendation. And Jen will be wrapping up the presentation with our secondary concerns as well as our implementation plan. So some of the key areas that we think are critical to your current situation are that you are currently pursuing the acquisition of DRB. Now, this is relevant because the industry is currently in a significant growth stage. Just in the past 6 months, the U.S. industry has seen a 15% growth in sales. So now is a really good time to be looking to buy. Also, although there are many competitors entering the market, you produce a premium quality product. So we think that you are in a good position to compete. Next, you're looking to structure this purchase in the most tax advantageous method. We're going to provide you with 2 alternatives to help you accomplish this. Also, you intend to include the new general managers within the ownership of the company. Now, this is important because we really want to make sure that the general managers have the best interest of the company in mind when making managerial decisions. Next is that there's several opportunities that exist to develop environmentally conscious processes within your operations. And there's various tax credits available to entice you to do so. And Jen will be elaborating on this further in our presentation. And finally, the both of you have a number of personal tax considerations that are unique to your current situations, and we want to address them separately. So the primary issue that we are going to be discussing today is the acquisition of DRB. Evan will be going over our 2 alternatives momentarily. The secondary issues that Jen will be elaborating on are the loan to the general managers, as well as scientific research and experimental development expenses. Next is the financing of the acquisition, and finally your personal tax considerations. So we've identified 3 decision criteria in the analysis of our alternatives. The first one being tax efficiency. So we want to make sure that your tax structure is simple and efficient. This means this will allow you to focus more on the operational side of your business. Also, it will clarify the tax implications of your different types of income, which is important. Also, the second decision criteria is asset protection. So we want to make sure that your assets are separated from the operations of your business. And this just ensures that your assets are protected from any sort of legal and contingent liabilities that your operations may incur. The third decision criteria is structural efficiency. Now, this is with regards to the general managers participating in the ownership of the business. We really want to make sure that the managers participate in the growth of the operations that they have contributed to. Next, our 2 alternatives are the purchase of DRB by WBA directly, and our second alternative is the use of WBA as a holding company to purchase DRB as well as separately hold Happy Hoppers. So the 2 companies would be separate. Next, I'd like to invite Evan up to further discuss these alternatives.
Thank you, Leah. So as we just introduced for you, our first alternative is to purchase DRB using WBA directly. Under this alternative, you would be negotiating through WBA with Mr. Barker to purchase the shares of DRB, and then you would hold the operations of that company within WBA while continuing to operate Happy Hopper through WBA as its own corporation. This does allow for the expansion you have expressed interest into Northern City while maintaining your operations in Western City, where you know there is a growing market. Just to give you a visual representation of the proposed corporate structure, you both would continue to be the co-shareholders of WBA, which would operate Happy Hopper again, and also be holding DRB as a separate corporation operating DRB. Because WBA does operate its own business, it would be generating business income within those operations, while also achieving dividend income through the flow up of the business income of DRB through the corporate structure up to WBA. This does result in increased complexity in filing your tax returns, as there's multiple types of income, which again creates more time and effort on your part filing your tax returns. We know that you're small business owners and you have a lot going on with running and managing your businesses, so we do want to simplify the structure as much as possible so you can focus on the core operations and growing your business in the future. Each corporation does hold its own assets under this alternative, which means that WBA would be holding and operating assets as well as DRB doing the same. Because you are in the food and restaurant industry, you're open to a number of significant risks related to litigation and potential accidents that would be unfortunate but do happen in an industry such as yours. This is a large concern for many owners of brew pubs such as yourselves. And under this alternative, should any potential litigation arise in the future, you would be liable for the full amount of the business assets that are held within each of these corporations should creditors come after those assets. This does not provide very much asset protection, as any and all assets held within those corporations are available in that litigation settlement process and would be available to those claimants. So again, your assets are subject to significant risk under this alternative. This structure also does not provide segregation of the ownership of WBA and DRB. So what this means is, because you have interest in introducing your new general managers to the ownership structure, doing so with DRB would be relatively simple. As again, WBA is the sole shareholder, you can introduce a new equity participant into the ownership structure there, and again, that new general manager would be able to participate with DRB. However, when in the future you're looking to introduce the new general manager of Happy Holdings to the ownership of WBA, you would be indirectly also introducing him into the ownership of DRB, because DRB is held by WBA. So this again complicates the corporate structure in accomplishing your goals moving forward. Now moving on to our second alternative, which again is using WBA as a holding company. So under this alternative, you would again be negotiating with Mr. Barker to acquire the shares of DRB and then holding those shares within WBA. But as opposed to the other alternative, you would be rolling all of the assets from DRB up into WBA, which would then hold all of the active business assets of both operations. After this is complete, you would be incorporating a new business, a new corporation, which would act as an operating company alongside the DRB, which you just acquired, which would both be fully owned by WBA. WBA would then lease all of the business assets down to the operating companies, allowing them to operate their brew pubs in Northern and Western City independently. Again, to give you a visual representation, you would both continue to be the co-shareholders of WBA, which would be operating as a holding company, and would then be holding both DRB and Happy Hopper, the two operating companies of those brew pubs. Because under this structure we are separating the operating companies, which would generate business income, into two separate operating companies, which would then flow that business income up as dividend income to WBA, which would also have, of course, rental income because of those leased assets to the operating companies. We're greatly simplifying your overall tax returns. Again, we're just making sure that each company only has one type of income, or two in the case of WBA, allowing you to simply file your taxes at the end of the year, as well as prepare for future tax planning in a much more efficient manner, allowing you again to focus on your business. WBA would also hold all of the assets, as I mentioned, or significantly all of the operating assets, which means, again, being in the food and restaurant industry, any risks that you are subject to at the operating business level would be contained within those operating companies, and any creditors coming would not have access to the operating assets, which would be held in WBA. This is a very common practice in an industry such as yours, and would put you on par with the leaders in the industry in terms of asset protection. The structure also does allow for better segregation of ownership. Again, you're looking to introduce your general managers into the ownership structure of the operations which they have control over. And because WBA would be the sole shareholder of both Happy Hopper and DRB, the operating companies, you could introduce new equity participants into those individually without introducing either of those general managers into the company as a whole, allowing for better control of your future ownership structure. Now looking at our decision matrix to evaluate the two alternatives against the decision criteria which we had discussed earlier. Again, in terms of tax efficiency, holding DRB with WBA directly does create significant complexity in filing your tax returns, whereas WBA as a holding company significantly simplifies the process of filing your taxes on an annual basis, which sets you up for future success inside of your business. In terms of asset protection, again, holding the business assets inside of an operating company, especially in industries such as your own, is generally not the best practice. It's much better to hold those within a holding company so that, again, creditors don't have access to those should any unfortunate accidents arise in the future and litigation arise from that. Finally, the structural efficiency in relation to accomplishing your goal of introducing your new general managers into the ownership structure. Again, using the holding company does allow for a much simpler and more effective means of implementing that and would allow you to, again, provide the right incentives for your new general managers through ownership of their operations only and an equitable equity stake in the operations. As you can see, we are recommending to use WBA as a holding company with the two operating companies below it operating Happy Hopper Brew Hub as well as DRB Brew Hub. Again, you would be leasing the business assets down to those two operating companies, and this does provide that tax-efficient structure which we are searching for you. It also provides the correct asset protection structure, which again is very common in industries such as your own with significant risks exposed to you. And the structure is also very friendly to the inclusion of future general managers, which is something you have indicated as part of your plan. I'll now be inviting Jen to come discuss a number of secondary issues as well as our implementation plan.
Thank you, Evan. So now that we've discussed the main issue at hand, I'd like to go into a few of the secondary issues that you raised concern over in the earlier meeting with our firm. So first of all is the interest-free loan to the general managers for them to purchase their equity stake within the company. Now, interest-free loans are a great benefit for shareholders. If certain conditions are met, the interest-free loan would result in only an imputed interest benefit to the general manager on their tax return. This means that they would have to include a taxable benefit, the current CRA prescribed rate of 2% interest on their tax return. However, they would not have to include the principal amount as income on their tax return. So that's a huge benefit for the general manager. There are certain conditions that must be in place in order for this very efficient loan to be available. One of them is that the interest-free loan must also be available to all other employees of the company. It essentially must be because of the employment relationship that the general manager has to the company, not the shareholder relationship. There are also certain conditions as to what the loan can be used for. However, one of those conditions is the purchase of shares of the related corporation, and as a result, that condition is met. Next, I would like to discuss the scientific research and experimental development expenses. Now, Mr. Wall, you mentioned that a friend of yours said that this may be something that your company would qualify for. Now, tax credits are available for certain scientific research and experimental development expenses. The credit is 35% of expenses up to $3 million and then 15% of expenses over $3 million. Now, the credit amount does decrease as your income increases, but again, once you reach that threshold, that's something we can discuss further. Now, we believe that this would provide you with a great opportunity to invest in more environmentally conscious beer brewing processes. For example, reducing water and energy usage. You're obviously very passionate about the communities that you're involved with, and we think this is a great way to continue this community involvement and to really give back to the community you're involved in. As well, it would provide you with a competitive edge, which is key in your industry in order to maintain your market leadership position. Next, I'd like to move into the financing, the purchase of DRB. You mentioned that you were pre-approved for financing from your bank, and we just wanted to discuss a couple of tax issues related to debt financing. Now, financing the purchase through debt does provide further tax reduction opportunities. Interest on debt is deductible for tax purposes, and this reduces taxable income. So again, this is a great way to reduce your taxes by the amount of interest that you're paying, and essentially it does reduce the interest rate that is offered to you by your bank. It is important to note that your bank may impose certain covenants on your company when you obtain financing, so this may mean maintaining certain working capital or certain debt to equity ratios. However, in our review of your financial statements, it appears that your company is very strong financially, and we don't believe that these covenants would be a major concern or issue for you. Next, I'd like to move into the personal tax considerations that you mentioned. Now, first of all, you're both currently taking a salary out of WBA, but you are interested in perhaps moving into dividend compensation rather than salary compensation. Now, you did express that you like salary compensation because you were able to deduct it from your corporate income for tax purposes. However, While dividends are paid out from after-tax income, there is a dividend refund available on your tax return when dividends are paid out to shareholders. And as a result, the ultimate tax consequences of salaries and dividends are equivalent for both the corporation and the shareholder. Dividends also provide greater flexibility with regards to the timing and amount of distribution. They're not a function of the employment duties you provide, but rather your shareholder relationship. So the CRA, with salary, the CRA would want to ensure that the salary matches the employment duties. That's not the case with dividends. Now, Mr. Wall, in 2013, you had a capital gain of $200,000 on farmland, as well as a farm loss of $2,500. You can use something called your lifetime capital gains exemption to reduce the gain on the farmland. There's $800,000 of this available, so you would be able to reduce almost the entire gain. I say almost because of the loss. Because you have that farm loss, it reduces the amount of gain you can claim at this time. So it wouldn't reduce the entire amount, but it would reduce it to half of your farm loss. So you would only have a gain of $1,250. And Mr. Wilson, you were eligible to claim a small business loss of $55,000 in 2012 as a result of the bankruptcy of your former consulting business. This would reduce your 2012 taxable income, and it can offset all types of income because it's a small business loss. As well, we noted that you do have a young child and another on the way. So we think that investing in RESPs would provide tax incentives for you in saving for your children's education. I'd now like to move into our implementation plan for our recommendation. We split this into 3 separate time frames, and the first is immediately within the next month. You're going to want to obtain the financing from your bank. You have been pre-approved, but you want to ensure that that financing is in place for the acquisition. Then you'll want to complete negotiations with Mr. Barker to purchase DRB. We analyzed the purchase price that is currently in negotiations, and we believe that that price is fair, and you should go ahead with that price. Next is in the 1 to 6 month time frame. You're going to want to complete the purchase and the installation of the equipment needed to transform DRB into a brew pub. You will have to do some significant renovations and installation of that $250,000 of equipment. So of course that will take a bit of time to get that new brew pub up and operating. You'll also want to begin to search for the new general manager of DRB. And again, you'll want to ensure that you have the terms of the loan lined out and you decide how much equity that you want to offer. You'll also want to file the articles of incorporation for your new operating company. So you'll want to set up that operating company that will operate the Happy Hopper Brew Pub rather than operating it out of WBA. And lastly, 6 months and into the future. You're going to want to hire your general manager and incorporate the interest-free loan into terms. So when you're negotiating with your general manager, you'll want to ensure that they understand the terms of this loan and the equity stake that they will have in your company. You'll also want to begin monitoring scientific research and development expenses for available tax credits and really move into developing those new processes that will really give you that competitive edge. And lastly, implement the personal tax recommendations that I just discussed into your 2014 tax returns. And this is to avoid any penalties that you may have with the CRA for not filing these on time. And of course, that's something everyone would want to avoid. So lastly, I'd just like to move into a couple of risks that we did note and the mitigation we have for these risks. So of course, the food service industry is subject to significant risk related to accidents. But holding the assets in WBA does provide protection from claimants resulting from litigation. It protects your assets and really does protect you from that litigation. We think this is a very important issue. As well, there is increased competition in the craft beer market, and this could lead to oversaturation of the market. However, we believe if you go forward with the scientific research and experimental development spending, it will ensure that you maintain a leading market position and you really have that unique niche within the market that really separates you from everything else. So in conclusion, we are going to recommend transforming WBA into a holding company to hold assets related to growth brew pubs, which will then be operated through separate operating companies. The new corporate structure accomplishes the efficiency related to your goals, and it will also provide asset protection from any potential litigation. We'd like to thank you for taking the time to meet with us this afternoon and open the floor to any questions you may have for us.
Thank you. This concludes the presentation. The question and answer period will now begin.
I like the idea of the assets being in a separate company, and then being rented back to our operating companies. I'm just concerned about the tax rate, because I know there's a higher rate of tax on rental income, and would that come into play here, or is there some kind of exemptions?
We do believe that the new corporate structure does outweigh, the rental income does have a higher tax rate. However, we can negotiate relatively low rental terms, still within the bounds that the CRA would accept in terms of those rental terms. However, we do believe, again, because of the asset protection, the new corporate structure does provide a greater benefit overall, despite the increased tax rate, which is going to accomplish, or will give rise to a relatively small increase in taxes payable overall. So overall, we did weigh that option against the benefits, but we do believe the benefits do outweigh the costs.
And with holding those assets in the holdco, are there any tax implications on the mechanics of transferring those assets into the corporation?
We did consider that as well, and under the section 85.1, we can roll over those assets from TRB up into WBA tax-free at their current tax cost, so there wouldn't be any tax payable on that transfer of assets up to the holding corporation.
Also on that note with WBA, we would just be incorporating Happy Hopper without any assets, so there would no, WB already holds those assets, so there would be no tax implication there.
In your implementation plan, you talked about completing the purchase in a relatively short term, 1 to 6 months, and then hiring a manager after that. Have you thought about what you would do in the interim as Don would have left the business and you get to hire a manager?
We plan to do both of those things simultaneously, both completing the acquisition and the required renovations while also looking for a general manager of the company. And it's a great advantage because there are two of you that are partners in the business. So one of you can focus on WBA and Happy Hopper for the time being, while the other can focus on this. So we do believe that both of those can be done simultaneously.
And for the finance, like taking out the bank loan to purchase CRB, which entity in particular would be taking on that financing? Will it be the owners or will it be the corporation?
That financing will be taken on by WBA, the holding corporation, because again, they will be the one purchasing the shares. And if you were to take on that loan personally and then transfer it over to WBA, there would be tax consequences because you would have to include that loan in your own income. So it would be the holding company that would take it up for tax purposes and also simplicity.
Would it be advisable for me to take some salary to lower the corporate income, take advantage of the small business production, and then maybe look at dividend payout above that? Or would it be better off just taking everything out as dividends?
We definitely think that taking a salary is advantageous just in terms of keeping the CRA happy. In terms of dividends, that's where the flexibility comes in if you want to obtain extra income.
Just to add to that point as well, you mentioned the small business deduction limit, which is $500,000. You're currently operating an income below that, so whether you take salary or dividends, the same tax implications would come into effect. However, if you do see that because of the new acquisition you are becoming over that $500,000 limit, then it may be advantageous to increase the salaries to reduce the corporate income below the small business deduction limit to reduce or to avoid the higher tax rate on any income over $500,000.
In the event that I do need to move money from one company to the other, what's the structure I should use to do that? What methods?
Well, one great advantage to our structure from a tax perspective is that dividends can flow tax-free from a taxable Canadian corporation. So if you're flowing dividends up from one of your operating companies to your holding company, that's tax-free. You can hold that money in the holding company until you decide that you need it personally or perhaps want to use it on another investment. So we believe that that's a big advantage to our strategy.
Did you give any consideration to potentially buying Don's restaurant through assets as opposed to shares? If we're going to move the assets out of the company.
We didn't consider that as we didn't have information relating to the assets and therefore couldn't calculate the tax impact of assets versus shares. And given the relatively little information that we had regarding his business, as well as the the terms which we are negotiated, which we deem to be very favorable given the purchase price and the business that you're getting. We thought the value was quite good, and we do agree with the purchase price of $850,000 for the shares, and therefore we didn't put too much thought into the assets versus that.
And just to elaborate on my comments, what I
Stop
just
you.